Right now, if the price of Bitcoin drops just, well, a few percentage points down to $69,000, an absolutely staggering $16 billion in long positions will just instantly vanish.
Yeah, completely wiped off the map.
Liquidated.
Yeah.
It's gone. So welcome to Bitcoin Deep Dives by My Crypto Paradise. Consider this your exclusive pass right into the inner circle.
Exactly. We're bringing you directly into the Paradise Team family today.
Because, navigating this space, it isn't about staring at flashing lights on a screen.
Yeah.
And it's definitely not about reacting to whatever crazy headline is trending on social media.
Oh, absolutely not. That's a trap.
Right. It's about cutting through the absolute panic, cutting through the endless hype of the crypto market so you can build a foundation of absolute trust and, most importantly, long-term profitability.
And that structural reality, that's just the perfect place to start because we aren't here to chase the noise of the crowd.
Never.
We are here to decode the underlying mechanics of the market. And when you see a massive asymmetry, like $16 billion hanging in the balance, it tells you everything you need to know about the psychology of the people who are currently trading.
So to really unpack this, our mission for today's deep dive is to deconstruct a recent, highly intense strategy session from Imminent on the Paradise team.
Yeah, Imminent really laid it all out.
He did. We're taking a hard look at real-time Bitcoin market data to expose the ultimate difference between a professional trading mindset and, well, a gambling mindset.
Which is where most people get stuck.
Exactly. We're going to explore the behavioral science behind why so many people just lose their shirts in crypto over the long run, even if they manage to get lucky in the short term. And we'll lay out how you can adopt the psychological armor and the tactical precision of a true professional.
Because it really just comes down to survival and mastery. And I gotta say, the timing for this discussion, it couldn't be more critical because under the surface, the market is currently flashing a massive structural warning sign.
Yeah, it really is.
Which brings up a fascinating paradox regarding the smart money right now. We are actually seeing massive veteran Bitcoin mining companies completely emptying their reserves.
Okay, now on the surface, that looks terrifying. If the people making the asset are dumping it, your natural instinct is just to run for the exits.
Right, the sky is falling.
Yeah, but we're going to look at why that exact behavior might actually be the secret signal for the next massive wealth-building opportunity. But before we get to the miners, we really have to look at the people currently providing the fuel for this market.
The retail side.
Yeah. Let's look at that staggering liquidation data Imminent shared. We have this massive imbalance. Pushing the price up to $89,000 would liquidate about $3.7 billion in short positions.
Which is a lot, but
dropping to $69,000 wipes out $16 billion in longs. $16 billion.
The disparity there is just, well, it's alarming. It paints a picture of a market heavily skewed by emotion rather than fundamental value.
Okay, let's unpack this. Because when I first saw that $16 billion figure, I immediately pictured a massive boat where like 90% of the passengers have suddenly rushed to one side.
Oh, to look at something shiny in the water.
Exactly. It feels like a massive party over there on the deck. Everyone is cheering, having a great time, and they just assume the boat is going to keep gliding forward.
But structurally, the boat is tipping.
It's a disaster waiting to happen. And it's important to understand the actual mechanism of why that boat tips. Because this upward price action isn't being driven by people buying and holding actual Bitcoin in cold storage.
No, it's being driven by heavy, heavy leverage.
Right.
And that mechanism, that is the trap. Because when retail traders use, say, 50 or 60 times leverage on a futures contract, they are essentially borrowing massive amounts of money from the exchange to amplify their position.
Which feels great when it's going up.
Sure, but if you are leveraged 50 times, a mere 2% drop in the price of Bitcoin means your entire underlying capital is wiped out, gone.
Wow, 2%.
It's 2%. And at that point, the exchange, they don't ask politely for you to deposit more funds. They just automatically force sell your position to protect their own capital.
And then that automatic force sell pushes the market price down just a tiny fraction more.
Exactly.
Which then triggers the next guy's liquidation point and the next guy.
It creates a cascading avalanche of forced selling. That is the boat capsizing. And from a behavioral science perspective, this perfectly illustrates the gambling mindset.
Because why else would you crowd onto one side of the ship?
Right. You have to ask why a crowd of retail traders takes on that kind of risk. It's because they are entirely outcome-based.
Yep.
They are driven by an emotional addiction to the dopamine hit of a massive, sudden profit.
They completely bypass the mechanics of how that outcome is achieved or, the risk required to get there. They just want the payout.
Yep.
The actual plumbing of the trade is completely irrelevant to them.
Entirely irrelevant. But when you look at a professional like the traders operating within the My Crypto Paradise system, you see a completely different psychological wavelength. A professional is entirely process-based.
Right. And Eamon brought up a casino analogy in the strategy session that really isolates this behavior, didn't he?
He did, and it's brilliant. Retail traders treat the market like a tourist treats a casino in Vegas. You walk in off the street, you put your life savings on black at the roulette table, and maybe the wheel spins your way.
You win. You feel like a total financial genius.
Exactly. But your underlying process is fundamentally broken.
Because the math of the universe is quietly working against you the entire time.
It's literally written into the foundational laws of probability. A roulette wheel has green 0 and double 0 slots. The casino always has an edge.
They don't build those massive hotels by losing.
Exactly. So in trading, if your underlying process is flawed, if you are risking too much capital on low probability setups driven by emotion, your edge is negative. And the law of large numbers dictates that if your edge is negative, the longer you play the game, the closer your chances of total ruin approach 100%.
I mean, you can get lucky on a few trades, absolutely. But time is the great equalizer.
It really is. And this is exactly why so many people get wiped out in crypto over a multi-year cycle. They confuse a lucky outcome with a successful process.
While the professional is sitting there asking a much more boring but infinitely more profitable question, what are the specific, repeatable steps I need to take to generate consistent profit over the next decade?
They aren't looking for the quick high.
No. And because professionals ignore that emotional noise, they know better than to look at the crowd of retail traders to figure out where the true market bottom is.
Because the retail market is just acting emotionally.
Highly leveraged, panic selling when things dip, FOMO buying when things pump. To find the real bottom, the Paradise team looks at the entities that are structurally forced to operate rationally.
The institutions and the heavy machinery of the network. The Bitcoin miners.
Right. And the historical data Aman presented on this reveals a very counterintuitive pattern.
It really does.
If you look back at the historical rhymes of the market in 2016, 2019, 2020, and the brutal bear market of 2022, the true generational bottom of the market never arrived when retail traders were freaking out on social media.
No, the true bottom only arrived when the big institutions, and especially those Bitcoin miners, were forced to sell their massive holdings.
Sometimes even their physical mining hardware, right?
Yeah, exactly, at a massive loss. It pushes a specific on-chain metric called the net unrealized profit and loss deep into the red.
We should probably break down how that metric actually functions, just because it's so crucial for separating the signal from the noise.
Yeah, definitely. So the net unrealized profit and loss, or NUPL, looks at the blockchain ledger. It calculates the difference between the price of every single Bitcoin the last time it was moved on the chain versus its current price today. When that metric goes deep into the red, it means the network as a whole is sitting on massive unrealized losses. But what's fascinating here is the behavioral difference between panic selling and forced selling,
which are two completely different mechanisms. Retail traders panic sell out of fear. The price drops, their heart rate spikes, they imagine losing everything, and they just hit the sell button.
Because they physically and psychologically cannot handle the pain of holding.
Exactly. But miners, on the other hand, do not sell out of emotion. They sell out of mathematical survival.
Right. Because mining Bitcoin requires massive overhead. You have industrial-scale electricity costs, continuous hardware maintenance, facility leases, payroll.
It's a massive physical operation.
It is. So when the price of Bitcoin drops below their average cost to mine it, those massive companies start bleeding fiat currency rapidly.
They're basically trapped by their own operational costs.
And eventually, if the price stays suppressed long enough, their fiat reserves just run dry. They are forced to liquidate their Bitcoin reserves, the very asset they believe in, just to keep the lights on and avoid bankruptcy.
Wow.
But looking at the data Aman shared from the current market, we are not yet seeing those deep red numbers on the NUPL metric.
So the true structural force capitulation simply hasn't happened yet?
Not yet.
Okay, but I have to push back on this concept for a second. If I'm listening to this, I'm trying to run the logic all the way through.
Sure.
The miners are the people who literally manufacture Bitcoin. They maintain the security of the entire network.
Sure.
If they're going bankrupt and they are forced to dump their massive multi-million-dollar reserves of coins onto the open market, wouldn't that massive influx of supply just destroy the price permanently? I mean, why on earth is an industry-wide bankruptcy event considered the signal for the bottom?
I mean, it's a very natural assumption to make, right? That massive supply would just crush the price to zero. But it brings us to a mechanical concept that professionals call the exchange of hands.
The exchange of hands.
Right. When these massive entities are forced to dump their assets at a loss just to survive, the selling pressure is indeed immense. But the price eventually stops falling.
Why?
Because the smart money, the patient, disciplined capital, like the Paradise team, who have been preserving their wealth and stable assets while everyone else was gambling, they finally step in. They have the liquidity to absorb that forced selling.
Ah, so they are basically standing at the bottom with a giant bucket, waiting for the capitulation to finish.
Exactly. The true bottom is forged at the exact moment when that massive, desperate selling pressure from the miners no longer pushes the price down significantly.
Because the bucket is catching it all.
Right. It creates a massive divergence on the charts. The forced sellers are throwing everything they have onto the market, but the price holds steady because the smart money is quietly eating up all that liquidity.
And this creates the structural imbalance that professionals eagerly await.
Yep. It marks the transfer of assets from weak, over-leveraged hands to strong, disciplined hands.
Which brings us to the warning sign flashing right now with a company called Bitdeer.
Oh, this is fascinating.
It really is. Bitdeer is one of the largest, most veteran, publicly traded mining companies out there. And Eamon noted in the strategy session that they just completely emptied their Bitcoin reserves.
But they didn't do it at a loss.
No. They did it essentially at break-even.
Which is a brilliant, highly calculated move by a veteran player who actually understands market cycles.
Because they know what's coming. They have been through the previous bear markets. They know that if they hold on to that Bitcoin and wait for the real drop, they will be forced to sell it at a massive loss later just to cover their electricity bills.
So by selling now at break-even, they are building a massive fiat war chest to survive the coming winter.
Exactly. But contrast Bitdeer's action with the flood of new mining companies that only just started their operations in 2023.
Oh, the novices.
Yeah, these novices have only ever known an upward trending bull market. They have no historical trauma.
And they likely have very weak fiat currency reserves because they just assumed the price would only ever go up.
So when this market really turns the screws, those 2023 miners are going to face brutal forced capitulation.
Which logically forces the immediate question for anyone listening. If we know this capitulation is a mathematical certainty for these over-leveraged 2023 miners and the $16 billion in retail longs, how do you physically position your capital to avoid getting caught in their blast radius?
Right. How does a My Crypto Paradise professional maneuver right now?
Exactly.
Well, this is where we transition from understanding the macro theory into executing professional tactics. Eamon uses an analogy that I think completely changes how you view a price chart.
The breathing organism.
Yes. He describes the market as a breathing organism. It doesn't just move in straight, logical lines. It moves in a cycle of 5 breaths. Inhales moving up, exhales moving down. And it breathes this way because it is constantly searching for oxygen.
And in the financial markets, oxygen is liquidity.
Exactly. And that liquidity is sitting right at the stop-loss orders of the retail traders. According to the Paradise Team's analysis, right now the market is on a low time frame exhale.
But we are still waiting for that final, deep, fifth breath downward to fully flush out those naive 2023 miners and grab that $16 billion in liquidity.
So what does this all mean for the charts?
Well, the technical roadmap for anticipating these breaths is grounded entirely in probabilities. Based on the current data, there is roughly a 75% probability that the market will first push up to fill what is called a CME futures gap at around $84,000.
And for anyone unfamiliar with how these gaps form, it basically comes down to trading hours. Traditional markets, like the Chicago Mercantile Exchange, where institutional Bitcoin futures are traded, they close over the weekend.
Right, but crypto trades 24/7.
Exactly. So if Bitcoin makes a wild price move on a Saturday or Sunday, when the CME opens on Monday, there is an empty pocket of liquidity on their chart. The price literally gapped up or down.
And because nature abhors a vacuum, the market price often acts like a magnet, eventually reversing course to trade back into that empty pocket and fill the gap.
And right now, the data suggests a strong magnetic pull upward. to fill that $84,000 gap.
Yes, and this upward push is supported by a bullish divergence on the MACD histogram.
The MACD, which is a momentum indicator.
Right. To visualize a divergence, imagine watching a car driving up a steep hill. The car is still moving forward and higher. That's the price action. But if you look at the dashboard, the engine is losing RPMs.
The momentum is dying even while the car rolls forward.
Exactly. When a professional sees the price making higher highs but the MACD histogram making lower highs, it tells them a reversal is imminent.
The engine is stalling out.
It is. And if that momentum shift confirms on the higher time frames, the probability of hitting that $84,000 mark pushes up to 90%. However, that $84,000 to $86,000 range is acting as a thick structural ceiling of resistance.
And after hitting that ceiling, the next highly probable move is a sharp drop to fill the lower gap, sitting at $67,000.
And if you are holding a heavily leveraged long position right now, your stop loss is likely sitting right inside that $67,000 gap.
You are the liquidity the market is hunting.
Yep. From there, the ultimate target for that final fifth breath downward, the capitulation zone where those 2023 miners finally break, is projected to be in the $55,000 to $44,000 zone.
So how do you put this psychological armor on and protect yourself through this volatility?
Emin laid out the specific wealth preservation tactics deployed by the Paradise team, and it requires physical, mechanical action to separate yourself from the emotional heat of the exchange.
What's the first step?
First, professionals do not endlessly compound their day trading money. When they hit a winning streak, they don't simply roll the entire balance into the next highly leveraged bet.
Because that is the tourist at the roulette table leaving all their chips out for just one more spin. It basically guarantees eventual ruin.
Absolutely. Instead, the Paradise team physically withdraws those profits. They move them off the exchange entirely and into hard wallets for cold storage.
And they don't just hold everything in Bitcoin, hoping for the best during a downturn, do they?
No, they actively rotate that capital between Bitcoin, USDT, and PAXG.
Which is brilliant from a mechanical standpoint, because USDT gives you fiat-pegged stability, meaning your capital doesn't shrink during a Bitcoin crash. You hold your purchasing power.
Right.
And PAXG is a digital token backed by physical gold, providing a hedge against both crypto volatility and traditional fiat inflation.
By rotating into these assets, you are preserving the wealth you've already captured, positioning yourself to be the smart money waiting with a bucket at the bottom of the capitulation.
This strategy perfectly highlights the ultimate trade-off a professional makes every day. Everything comes down to balancing probability against the risk-to-reward ratio.
Yes. Sometimes you might identify a trade with a slightly lower probability of success, but the market structure allows you to place a beautifully tight stop loss.
Meaning your risk is microscopic compared to the potential gain.
Precisely. You secure an incredible risk-to-reward ratio where you don't get wicked out.
And getting wicked out is when the price spikes down just a fraction of a percent, triggers your stop loss, and then rockets back up in your favored direction, leaving you behind.
Finding those exact protected entry points requires deep technical analysis and constant monitoring. But it all anchors back to the absolute core mantra of a professional: risk first, profit second.
Risk first, profit second.
You never ask, how much money can I make? You ask, how much money could I lose? And what are the mechanical steps I'm taking right now to protect against it?
That is the armor. And the Paradise team always builds multiple plans. Plan A is that structural drop down into the $55,000 to $44,000 zone to trigger the minor capitulation and scoop up the liquidity.
But because they are process-based, they don't fall in love with a single idea.
Right. Plan B is ready if the market structure shifts from a bearish exhale to a bullish inhale. If that happens, they wait for strict technical confirmations, they reaccumulate their positions, and they target the next major macro resistance all the way up at $169,000.
It is a dynamic, living strategy. It respects the breathing organism of the market rather than trying to force an emotional desire onto the charts.
Which brings us back to why you were here, listening to this deep dive into the source material. Being part of the My Crypto Paradise family means adopting this exact behavioral philosophy.
It really does.
It means thinking in probabilities, not emotions. It means remaining calm, disciplined, and cash-heavy while the retail boat tips over.
And it means respecting risk management above every single other action you take.
Yes.
And crucially, it requires a complete reframing of how you view a losing trade. For the gambler, a loss is an emotional failure. It's a blow to the ego.
It triggers anger, revenge trading, and just more panic.
Exactly. For the professional, A loss is simply data. It is a necessary business expense and valuable feedback that sharpens the overall system. A process-based system is your ultimate safe haven in an environment that is algorithmically designed to prey on your human emotions.
When you have that process, the flashing numbers on the screen stop being a casino game. They stop being a source of anxiety. They become a roadmap.
A roadmap to actual wealth.
Exactly. So as we wrap up today's analysis of the inner workings of the market, I want to leave you with a thought to mull over. We spent a lot of time today exploring how the true foundational market bottoms are forged in the quiet desperation of forced institutional selling, rather than the loud, chaotic panic of retail traders rushing to one side of the boat.
A quiet desperation is key.
It is. So if the most important wealth-building signals in crypto happen quietly, mathematically behind the scenes, what other areas of your financial life are you letting the loud noise of the crowd distract you from the quiet, disciplined moves of the smart money?
A vital question for anyone looking to build lasting wealth, not just fleeting profits.
Until next time, stay disciplined, trust your process, and keep your balance on the boat.